We've got high rates and high prices, which at the moment gives us the most even playing field that we've had in almost 5 years, resulting in buyers having more leverage in many markets out there. But at the same time, it's really important to understand not all real estate is created equal. You've probably been told to wait until interest rates drop. But here's the truth. Waiting for perfect conditions could end up costing you more than acting in a high rate environment like today. The opportunity in this market isn't obvious unless you know where to look. In this video, I'll help you break down whether buying a home at a 7% interest rate actually makes sense based on your life, your finances, and your local market. We'll cut through the noise and I'll give you real framework to decide what's right for you. Before we jump in though, make sure you drop a comment and let me know if you would buy a home now at 7% if the right home popped up. Or are you holding out for say 6% or even lower? Now the thing to understand about 7% interest rates is that it sounds high, but it's near the historical average when you look back over time. And while we all have really short memories and we just remember those really low interest rates of the pandemic years, the reality is those rates were probably once in a lifetime. And the likelihood of us seeing an interest rate with a 2% handle on it ever again is going to be extremely rare. And the main reason for that is because we had a lot of things happening in the economy at one time. Not only did we have the pandemic going on, we had the federal government stimulating the economy with tons and tons of money. We had them buying mortgage-backed securities at a time when we had the federal funds rate sitting at 0%, which meant money was really cheap to borrow across the board. Now this in and of itself created issues because it pulled demand forward. It allowed people that already had mortgages to refinance them at super low interest rates, which is now impacting inventory in many markets out there. So what I'm getting at here is those interest rates that happened during the pandemic aren't really real interest rates in many ways. Yes, a lot of people out there have them, but they're not the normal interest rates. They're not what we're likely to see if interest rates move lower. One important thing to understand is that the Fed has been fighting inflation ever since the pandemic. Because of all of that money that was thrown into the economy, people were locked at home, not able to spend money. There were a lot of savings created. And once the economy was unlocked, all of that money got pushed back out into the economy, which created higher prices, partly due to supply chain disruptions, just an overwhelming amount of demand out there in the market. Again, that's one reason that we saw home prices shoot up so much during that period of time. Because not only did we not have enough housing for the people that were turning prime buying age, we also had a lot of demand being pulled forward because affordability was sitting at such high levels. And because of all of that, we had inflation running rampant. It hit 9.1% back in 2022, which again caused the Fed to change course, right? The pendulum swung from one side all the way to the other. And with that, we saw interest rates jump from the low 3% range upwards of 7%. So please understand, if you're one of those people out there waiting for 3 or 4% interest rates, those only come in a super weak environment. You need a market that's not only moving down, but moving towards a recession. And I'm not just talking a mild recession, I'm talking a big recession. And where I'm going with all of this is at the moment, the economy looks pretty stable. Yeah, things are getting weaker, slower, but it's not likely to be this big thing that happens overnight where you see the Fed ultimately change their game plan, resulting in much lower rates. Because the one thing that happens with lower rates is that it stimulates the economy, right? That's why the Fed has the federal funds rate. It is the rate at which banks borrow money from one another. So in an environment where the Fed funds rate is really low, that stimulates a lot of businesses to go out there and buy money, to create products, things that ultimately lead to a thriving economy. And the reason that's not likely at the moment is because the economy is stable. And if the Fed were to go out and start lowering the Fed funds rate now in an aggressive manner, that likely means businesses borrowing more money, the consumer borrowing more money, and that money is going to go back into the economy, which is going to drive prices higher, likely leading to higher inflation, which is exactly what the Fed has tried to combat over the last 3 to 4 years. So in my opinion, this idea of waiting for mortgage rates to go down is this fallacy that you're creating in your head that there's some sort of correction coming, that there is something that's going to change that's ultimately going to make it more affordable for you to become a homeowner. Which brings us back to this whole idea that we started with, that real estate is local. At the moment, about 30% of all of the active inventory in the United States is located in 2 states, Florida and Texas. And if you're located in one of those states, then you're probably seeing prices stabilize. You might even see prices go down in some cases. I've actually had viewers reach out to me talking about homes that they bought a couple of years ago, and they're selling them for less money than they bought a couple of years ago. And if you're in one of those markets, you have to be more cautious than, say, somebody located in the Northeast where it's still really competitive. There's not a lot of inventory. In many cases, there's multiple offers offers on homes. But with that, national headlines don't necessarily reflect local data. So if you are someone that is considering buying a home, we're going to talk about what to look for, how to put yourself in the best position to get the best deal. But before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything mortgage and real estate related, consider subscribing to the channel. So at the moment, you're probably seeing headlines from, say, Redfin, that there's 500,000 more sellers on the market right now than there are buyers, along with this idea that nearly 40% of the homes on the market at the moment have had some sort of price cut, especially with inventory up over 33% year over year. So all of these things seem like doom and gloom, giving you a reason to pause, giving you a reason to say, you know what, now's not the right time for me to buy a house. I'm just going to sit on the sidelines and wait for prices to come down. I'm going to wait for interest rates to come down. I'm going to wait for affordability to improve so that I can step in the market, get a deal, not have any regrets, which actually isn't a bad idea if all of those things could happen. But the reality is you're not likely to see home prices move down in a meaningful way. You're not likely to see mortgage rates move down in a meaningful way. And more importantly, you're not likely for a seller to just give their home to you, especially because many of these sellers have a ton of equity in their property. Many of them are sitting on super low interest rates. So unless they're in a position where they have to sell that home, chances are they're probably going to stick pretty close to their asking price. But my question for you is, are you waiting to buy a home because you can't afford it now, because the payment is too high, because the prices are too high? And the reason you're not pulling the trigger is because you actually need lower rates for it to make sense financially, for it to meet your budget. If that's the case, then waiting is completely okay. You should never have FOMO in one of these situations and go out and buy a home with the expectation that interest rates are going to move down and it's going to become more affordable in the future. But what I'm asking you is, can you afford it with all of your other obligations? If interest rates never move down again, are you in a position to continue making that payment? And if you are, and you're still not quite ready to pull the trigger, what I would suggest is start making a mock payment of something like that now. If your current rent is, say, $3,000 a month, but your mortgage payment is going to be $4,500 a month if you were to buy at 7% interest rate, start making a $4,500 payment. Just $3,000 to your landlord now, take that additional $1,500 and start putting it into an account as if you're paying that mortgage. And what that's going to do is it's going to do two different things. One, it's going to get you used to paying that higher amount, that you're already locking up that amount that you'd be spending on that mortgage at 7%. And the second thing it's doing is that you're putting money away. Maybe you're going to use that towards your down payment. Maybe it's a fund to pay off other debt. But either way, it starts getting you in the mindset of becoming a homeowner. Now, for me, the most important thing that happens in any market when it comes to real estate is the time horizon. I think right now you need to be thinking more than, say, 7 years, 5 to 7 years at least, probably closer to 10 years. And the reason I think you need to have that longer term time horizon is because home prices have increased so much in such a short period of time. Understand that when you look at real estate nationally, the annual increase over the last 65 years or so has been somewhere around 4.6%. But understand, we got almost 50% in just 3 years, which means we got almost 10 years of appreciation in just a 3-year period of time. So the reality is we need home prices to stabilize. In some markets, we need home prices to pull back slightly so that we get back closer to that long-term trend. And when you have a shorter-term time horizon, understand there are costs when selling a home, right? If you're going to only own that home a couple of years and prices, say, move sideways from the time you buy it, then chances are you're going to end up losing money during that period of time because you're primarily just paying interest the first couple of years. So you're not really paying down the balance of that mortgage. And then when it comes to sell, you're going to have selling costs, 3, 4, 5%, depending on where you're located, maybe even more. And I want to stress further, if you're doing a VA loan or an FHA loan where you're putting little to no money down, this is even more important because you don't have that cushion. You don't have that equity that you put in to start with when it comes time to sell that home. So by having that longer term time horizon, you're essentially mitigating the risk involved in that property. Now, that doesn't necessarily guarantee you success, but what I can tell you is, as a real estate agent over 20 years in the business, I've never seen anyone lose money over a 10-year period of owning real estate. So what if you don't have that longer term time horizon? What if you only have a short term time horizon? Should you consider renting? And my answer is yes. There's nothing wrong with renting a property. Renting is just buying you patience until you're ready to become a homeowner. At least that's what Dave Ramsey says, and I believe strongly with it. But at the same time, understand that there's no 30-year 30-year fixed rent. Rents are going to increase over time. And when you're renting, you're not creating any equity. You're not creating any appreciation. You have no control over that property. Whereas on the flip side, by owning a property, you're fixing your housing costs to some extent. You're putting money into a forced savings. You're getting that appreciation over time, along with potential tax deductions. And that's why many people out there have been able to build long-term wealth, even with 6, 7, 8% mortgage rates. And that's because they're buying when it's the right time in their life. And then as that property appreciates, they're getting the appreciation, they're paying down the principal balance of that mortgage every single month. And as interest rates move lower, they've been able to take advantage of those lower rates. So they're lowering that fixed cost over a period of time. Now, going back to this idea of being able to refinance as rates move lower, that's one of the biggest benefits of buying in an environment like we're in at the moment. You have increased inventory. You have 40% of the homes out there on the market have some sort of price cut. You got less buyer demand out there in the market. And so you have more leverage as a buyer than you've had in the last 5 years. Now, that doesn't mean for everyone you should go out and buy a home. But if it's the right time in your life, you've checked all the boxes that we've talked about, which means you're comfortable with the payment. You have money in the bank. You have a long-term time horizon, and you can find a property that suits what your family is looking for, then I don't see any reason to wait on buying that house. In fact, I think you should be buying that house because there's a really good chance that we do see interest rates move lower over the next couple of years. Now, that doesn't mean aggressively lower, but we are likely to see mortgage rates move down. Fannie Mae is predicting 6.1% by the end of the year, 5.8% by the end of 2026. And in my opinion, as you see mortgage rates move down, you're going to see more buyers come off the fence. We're sitting about 7% today. And they say about 4 million people come into the market for every 1% down that mortgage rates move. So you're going to have 4 million more potential competitors out there. Not everyone's going to be a competitor, but there are going to be more buyers out there in the market. And when you have more demand and more competition, that likely means you're going to have to get more aggressive when making your offer. So if you can come into an environment like we're in right now, that's a little bit slower, and find a seller that needs to move for one reason or another. Maybe they've already bought a home. They need to get rid of this home. Or maybe they're moving across country to be with their family and they have a deadline. Or maybe it's just the ugly house in the neighborhood that no one's looking at and the days on the market are adding up. In my opinion, those are the best opportunities in this market, is when you have a seller that is motivated to do something and no one else is interested in that property. That's where the real opportunity is in this market. A lot of people are looking at the market right now and saying 7% is too high. I can't afford it. It's not right for me. I'm going to wait for lower rates. I'm going to wait for lower prices. But the key thing to remember here is don't buy with FOMO, and also don't wait for a crash that's not coming. Now, if you're still wondering if 2025 is your year to become a homeowner, or if you should wait even further, do me a favor and check out this video here.